Alright, here we go. As of like 1 hour ago, the Fed increased the federal funds rate by 75 basis points. Inflation keeps going up and they keep trying to pull it back down. Now, if you're not an economist or an analyst or haven't been following this stuff for years and years, 75 basis points probably doesn't mean a whole lot to you because there's no context to apply that to. Is that big? Is that small? So in this video, we're going to take a trip down memory lane and look at the historical context for federal funds rate hikes. As a quick, very high-level reminder, the federal funds rate basically affects debt. The higher the federal funds rate, the more expensive it is to borrow money. That's all we're going to go into detail in this video. Our historical journey starts all the way back in 1990. This was the first year that the Fed really started tracking some of these metrics. Between 1990 and today, 2022, the Fed has increased or decreased the federal funds rate 96 times. It is their best tool to try and maintain a constant growth of 2%. If inflation gets too high, the Fed can raise rates, contracting the economy and pulling inflation back down. If the economy is not doing well, the Fed can lower interest rates, borrowing money becomes a lot cheaper, people start spending more money, and we start going back up. So there's been 96 times since 1990 that the Federal Reserve has felt like they needed to step in and do a little monetary correction. The rate hike today was 75 basis points. Out of those 96 times, there's only been that drastic of a change 3 times. One in 1994 and 2 times in 2008. In 2022, the Fed has raised interest rates 75 basis points 3 times, just this year. So from 1990 all the way until this year, the Fed has only raised interest rates by 75 basis points 3 times. Since January of 2022 to September of 2022, the Fed has raised interest rates 75 basis points an additional 3 times. That should be a big red flag waving. There was also talk that the Fed might raise interest rates 100 basis points. That's a full percent. Just like that. That has never happened since 1990. We've decreased interest rates by a full percent twice, but we have never increased interest rates a full percent, and that was on the table for discussion this time around. Now, as in anything that's even somewhat political, there are 2 schools of thought on this decision. One is that the Fed raised interest rates too high, and the other is that the Fed didn't raise interest rates high enough. The people that think that the Fed raised interest rates too much are worried that we're overcorrecting. A lot of the data that the Fed uses to make these decisions are lagging indicators. So you're looking at the previous month's data to make decisions today. So these people are saying, hey, we're already starting to see the effects working. We don't need to overcorrect and go into a worse recession or potentially a depression. But these people are saying that inflation is still at 8.3%. It should be at 2%. And we won't see a balance until the Fed raises rates above the inflation rate. With this most recent rate hike, the federal funds rate is only at 3%. Inflation's at 8%. So these people in this camp are saying we need to bring the 3% above the 8%. So that way we can start stomping on inflation and get a handle on it before it goes to the moon. Something like that happened in the 80s, and the hope is that we don't have to do that again because that would most likely send us into a very deep recession and on the verge of a depression. So the Fed is like right in the middle. It's aggressive enough to say, hey, we understand that inflation is getting out of hand, but not so aggressive that we just send prices plummeting because it's now impossible to take out a loan because interest rates are so high. So it's right in that sweet spot. So what does this mean for investing specifically in real estate? Mortgage rates are not tied directly to the federal funds rate. As a matter of fact, earlier this year, when the federal funds rate went up, mortgage interest rates actually went down. And so that could happen again, but mortgage interest rates only temporarily went down. We are now back up. So overall, this will most likely increase the cost of borrowing money across the board. So if you're looking to buy a house, it's going to be more expensive. If you're looking for an investment property, it's going to be more expensive. But here's what to watch out for. It's all about equilibrium, where supply and demand meet right in the middle. When interest rates get so high, demand goes way down. And so the easiest way to counteract that, and honestly the natural response that will happen, is that home prices will come down to try and meet demand. So we're going to hit a sweet spot. I'm thinking probably at the beginning of next year, 2023, where we get back to close to an equilibrium. The Fed will U-turn, meaning they'll stop raising rates, maybe even back off on rates a little bit, and house prices are going to start to go back up. And I think that's going to be the bottom of the market, and it's going to be a great time to buy. So thank you guys for watching. Hope you enjoyed the video. If you did, hit like, hit subscribe. It would mean the world to me. But nevertheless, thanks for being here, and I will see you next time.